Imagine a world on the cusp of a revolution. It's the late 1990s, and a new technology, the internet, is bursting onto the scene, promising to transform everything. People are buzzing with excitement, envisioning a future where information is instant and global commerce is just a click away. This wasn't just a technological shift, it was a cultural phenomenon. Suddenly, everyone wanted to be part of this digital gold rush. Companies with names ending in .com were popping up overnight, and investors, eager to ride this wave, poured money into them like there was no tomorrow. The stock market began to soar, fueled by a potent mix of innovation, optimism, and a fear of missing out on the next big thing. It felt like the dawn of an incredible new era, where fortunes could be made almost instantly, and the possibilities seemed limitless. But was it too good to be true? The internet gold rush wasn't just a metaphor. It was a reality for many. Startups with little more than a catchy name and a vague business plan were suddenly worth millions, even billions. Companies like Pets.com, which simply sold pet supplies online, were grabbing headlines and investor cash. The mantra was, get big fast. Profits could come later. Venture capitalists, fueled by the promise of astronomical returns, were throwing money at anything with a .com suffix. It was an unprecedented explosion of entrepreneurship, but also of speculation. People quit their steady jobs, convinced they could strike it rich by launching the next big online sensation. The stock market became a playground where conventional wisdom was tossed aside, replaced by the belief that the internet would defy all economic rules. Everyone wanted a piece of the pie, convinced it would only get bigger. But how long could this dizzying climb last? The late 90s were a time of irrational exuberance, where money flowed freely and dreams grew wilder by the day. Investment bankers and venture capitalists were practically throwing cash at any entrepreneur with a compelling story about how the internet would change everything. Business plans often contained little actual business. Instead, they focused on eyeballs and first-mover advantage. Companies were spending lavishly on advertising, Super Bowl commercials, and extravagant office spaces, often without a clear path to profitability. Analysts and media personalities fueled the frenzy, creating a narrative that traditional valuation metrics no longer applied. It was a dizzying environment where average people became overnight millionaires, at least on paper, simply by investing in these nascent internet ventures. But behind the glitz and glamour, a dangerous illusion was taking root, one that ignored fundamental economic principles. Could this house of cards really stand? The hype surrounding the .com era was a force of nature, amplifying every success and minimizing every warning sign. Media outlets breathlessly reported on soaring stock prices and instant billionaires, creating a powerful fear of missing out, FOMO, among average investors. Everyone from seasoned professionals to first-time traders was jumping into the market, convinced they would be left behind if they didn't. Companies advertised everywhere, splashing their .com names across billboards and primetime TV, often without a product even ready for market. Stock prices became untethered from actual company performance, driven purely by speculative fervor in the belief that the internet was an endlessly expanding frontier. The traditional rules of business, like needing to make a profit, seemed obsolete. It was a captivating spectacle, but the question loomed, when would this collective fantasy collide with cold, hard reality? The stage was set for an epic fall. The absurdity of .com valuations reached staggering levels, defying all logic. Companies with zero revenue and no proven business model were being valued in the billions. How? Investors were betting on potential, on future value, and on the sheer scale of the internet's reach. Metrics like price-to-sales ratio were discarded in favor of price to eyeballs or price per click, even if those clicks didn't translate into actual income. Analysts justified these astronomical figures by arguing that network effects and first-mover advantage would eventually lead to monopolies. But the truth was, many of these companies were burning through cash at an unsustainable rate, offering free services or heavily discounted products just to acquire users. the market seemed to ignore that simply having users didn't automatically mean profit. It was a high-stakes gamble on an unproven future, with massive fortunes hanging in the balance, and the gap between perceived value and actual value growing wider by the day. This couldn't last, could it?
Beneath the surface of soaring stock prices and euphoric optimism, cracks were beginning to show. Savvy investors and economists started voicing concerns, pointing out the unsustainable burn rates of many .coms and their lack of a clear path to profitability. How long can companies spend money they don't have? They asked. Early signs of trouble included numerous startups quietly shutting down or struggling to secure additional funding. The lavish spending habits, once seen as a sign of confidence, now seemed reckless. Some companies began desperate pivots, trying to find a viable business model before their cash reserves ran dry. The market, however, largely ignored these warning signals, preferring to believe the good times would roll on forever. Yet, the foundations of this digital empire were becoming increasingly shaky, and the whispers of doubt grew louder. Something had to give, and soon. The party was about to end.
Then, on March 10, 2000, the clock struck midnight for the .com fairy tale. The NASDAQ Composite Index, the benchmark for tech stacks, reached its all-time peak of 5,048.62. What followed was a swift, brutal descent. Initial corrections were dismissed by some as healthy market adjustments, but the reality was far more sinister. Investor confidence, once boundless, began to erode rapidly. The relentless flow of venture capital started to dry up, leaving countless startups stranded without funding. The media, which had fueled the bubble, now began to report on the impending doom, further accelerating the panic. It was a shocking reversal. The digital gold rush transformed into a stampede for the exits. The realization dawned that not every internet company was destined for glory. The dream began to unravel, and fear, a much more powerful emotion than greed, took hold of the market. The fall had begun, and it would be catastrophic. The .com bubble didn't just pop, it exploded with the force of a digital tsunami. Following NASDAQ's peak, the market plummeted with terrifying speed. Billions of dollars in paper wealth vanished overnight. Companies that were once darlings of Wall Street filed for bankruptcy protection or simply ceased to exist, often laying off thousands of employees in the process. Pets.com, Webvan, and many other high-profile startups became cautionary tales, their lavish spending and lack of revenue sealing their fate. Investor portfolios were decimated, dreams of early retirement shattered. The get-rich-quick mentality transformed into a frantic save-what-you-can scramble. The once bright promise of the internet seemed to turn into a bitter disappointment for countless individuals and institutions. It was a brutal awakening to the fundamental truth. Even in a revolutionary industry, basic economics still apply. The digital landscape was littered with the wreckage of shattered ambitions. The bursting of the .com bubble wasn't just an American problem. Its fallout rippled across the global economy. Major investment banks that had heavily backed these startups suffered massive losses. The stock market downturn eroded consumer confidence, leading to a broader economic slowdown. Many workers found themselves unemployed, contributing to a sense of uncertainty. The tech sector, once seen as invincible, was now viewed with extreme skepticism. It took years for the market to recover and for trust to be rebuilt. The .com crash served as a harsh, undeniable lesson about speculative bubbles and the dangers of irrational exuberance. It forced investors, entrepreneurs, and policymakers to reevaluate how new technologies should be valued and how sustainable growth should be pursued. The global economy had been shaken to its core, but from the ashes, a new, more resilient internet would eventually emerge. Though the .com bubble was a painful chapter, it ultimately forged a stronger, more sustainable internet. The speculative frenzy cleared, making way for companies with actual business models, clear revenue streams, and a focus on profitability. The collapse forced a necessary reset, weeding out the unsustainable ideas and paving the way for true innovation. Companies like Amazon and eBay, which survived the bust, learned critical lessons about efficiency, customer focus, and disciplined growth. This painful period laid the groundwork for the tech giants we know today, companies that didn't just have eyeballs, but also viable products and services. The internet, far from breaking the global economy, ultimately became its backbone, fundamentally changing how we work, communicate, and live. The bubble taught us that while technology can be revolutionary, it still needs sound business principles to thrive. It was a dramatic, expensive lesson, but one that ultimately propelled the digital age forward with a newfound maturity and resilience.